Welcome back to Intermediate Accounting. We are going to start talking about Chapter 18, which is all about shareholders' equity. So we're going to talk about the different aspects of shareholders' equity, and we're going to talk about how it's reflected on the balance sheet. So first of all, this all comes from external financing, which there are two different categories that external financing would fall under. There's debt and equity. If it's debt, it's going to be that the creditor is lending money. So that would create a liability, which typically is going to be reflected as a notes payable. Or we're going to have equity. This is going to be external financing coming from owners that want to invest money in the company. So we're going to see this as paid in capital. We are going to typically see that show up as common stock, or we're going to see it as additional paid in capital for common stock, but we're going to see the different things here show up under our shareholders equity section. So here's an example of the shareholders equity section of the balance sheet. If there is any type of preferred stock, which we're going to touch on in just a little bit, if there's anything like that, we always start with preferred stock. And they're going to give details like it's 10%, and that's talking about the dividends that would be paid out, $5 par, cumulative, non-participating. That is a lot that goes right next to that account, but by the time we're done with just this first video for Chapter 18, you're going to see what all of that actually means. So they've got 500, and this is probably in millions, 500 million in preferred stock. Then they're going to list out any common stock and what the par value is. I'm going to touch on this in just a little bit as well. So for the common stock, it has $1 par value per share, so they have 70 million in that. Then they have additional paid in capital. This is where a investor has paid extra on top of the par value in order to invest in this company. So there's another 420 million in additional paid in capital. Now, all three of those accounts are paid in capital. Those are ways that investors have put capital, have put money into the company. They are giving money to the company, hoping that they will get a return. And the company is going to take that money because they can use it to purchase assets and hopefully make more money from that. Then we're going to see our retained earnings listed. And as we already know, that's just going to be our profit from our normal operations reinvested in the company. Below retained earnings, a lot of times we're going to see accumulated other comprehensive income. So this is going to be some kind of loss or gain from one of 4 different possible transactions that are not going to show up yet in our retained earnings, but we are going to see it on the comprehensive income statement. So that could include a few different things, but that would be things like net unrealized holding losses or gains on investments. So if it's a loss, it'd be a negative. Net unrealized loss on pensions. We just talked about pensions in the prior chapter, so hopefully that is ringing a bell. We have deferred losses on derivatives in this example as well. Then finally, we might see treasury stock on a company's balance sheet in the equity section, and that is going to be a negative amount as well. Treasury stock is whenever a company has bought back some of their own shares of their company. So we add and subtract as necessary, and that gives us the total amount of shareholders' equity. So when it comes to reporting that shareholders' equity, as we saw, we have the paid in capital section that has preferred and common stock and any additional paid in capital. And then we have retained earnings, those profits reinvested. We may see some treasury stock, and we may see some AOCI, accumulated other comprehensive income, just as we saw in that example prior to this slide. So let's first talk about what does accumulated other comprehensive income consist of? So there are 4 possible things that we're going to see in accumulated other comprehensive income. So that could be the net holding gains or losses on available for sale investments in debt securities. So when we have available for sale, this is going to be where our company has purchased debt securities. So we've purchased maybe bonds from another corporation or from the government. And if it's available for sale, that means that they're not really actively trying to sell it, but they're not planning to necessarily hold it until it matures either. So for that reason, it's listed as available for sale. When that's the case, we are going to show any gains and losses from that investment only in other comprehensive income, which ultimately rolls into accumulated other comprehensive income once the period ends and they close out those temporary accounts. The next one would be gains or losses from an amendment to post-retirement benefit plans. So we saw that with the pensions. If there's an amendment, maybe they say, now we thought that they were going to make $480,000, but we realize they're probably going to make more like $500,000 when that employee retires. So for that reason, we are going to go ahead and recognize a loss on the projected benefit obligation. That does not show up in the regular income section. Instead, that's going to be in other comprehensive income, which at the end of the year, at the end of the accounting period, they are going to close that out into accumulated other comprehensive income. Same things for the deferred gains and losses on derivatives, which is another type of investment. We don't actually get into derivatives in intermediate accounting, but that would show up in AOCI. Then we have adjustments from foreign currency translation. So again, we don't really get into this either in this class, but this is where a company is maybe solely based in or primarily based in the United States, but they do some business in other countries. And because of that, they may have a little bit of gain or loss whenever the currency is translated to the US dollar. And it can change over time. So because of that, there's sometimes a gain or a loss there as well. So accumulated other comprehensive income is it's just going to capture all of these kind of one-off things that are not in the normal business operations, and maybe they're not even realized yet. So this is what the statement of comprehensive income can look like. It's going to start out with your net income from your normal business operations and maybe some gains and losses. Then you're going to list out any of those 4 different categories that we just discussed. If they're a gain, they're going to be a positive amount. If they're a loss, they're a negative, of course. So then we are going to add or subtract that total from the net income, and that shows the comprehensive income. Comprehensive income being anything that has come in or is going out that did not come from owners' transactions. So there's our comprehensive income statement. So let's talk about different types of organizations and how we can structure those. So corporate organizations. First of all, we have limited liability. So with a corporation, it offers this limited liability where instead of like, if I started a business and I was just a sole proprietor and something were to happen and I were sued, then I wouldn't have any liability protection if I did not set up some type of corporation. But if you set up a corporation, it will give you limited liability. So that makes it a separate legal entity. So it's not me, it is a separate legal entity. It's 2 separate beings. So it's responsible for its own debts, and the owner is not going to be responsible themselves. Any shareholders are going to be limited to the amount that they invest. So again, they have that protection. Another good thing about a corporation is it can be easy to raise capital because you're going to be able to get investors easier, especially if it were to be a public company. It's really easy to get people to invest whenever the shares are sold on the stock exchange. So they can do that, or if it's a private company, you can get investors privately as well, and that can be easier because they're not afraid of the liability here. So those are the advantages of a corporate organization. Then we have the disadvantages. So here are 2 major disadvantages that would stop a business from wanting to be a corporation. They face double taxation. So none of us want to pay taxes, right? And with a corporate organization, in a lot of cases, those corporations are first going to pay income taxes for the company. So they've paid income taxes. Then when those earnings are distributed as cash dividends, the shareholders are then going to have to pay income on that. So they're taxed as the corporation, then they're taxed whenever the investors get those. So that is a big negative to having this type of corporate organization. Also, the reporting requirements are much more challenging. So if you have a corporation, the government is going to make sure that you meet their criteria, you meet their standards, and that can make it more challenging. Because a lot of us are just like, I just want to run a business with something that I'm passionate about and I want to make some money. But having to go through all of this red tape can be challenging as well. So some different types of corporations. There's a not-for-profit. So typically businesses, their main reason for existing is because they want to make a profit. But there are not-for-profit organizations. Those are either going to be like charitable organizations that are in the public sector, or they're going to be government organizations. And those are not created to earn money. Instead, they are created for the greater good of those around us. But in other cases, any other case, we assume that a corporation or any kind of business is there to make money, right? Maybe they're still doing some good things on the side with the money they're making, but ultimately they're there to make a profit. So LLCs, limited liability companies, you've probably seen businesses before that end with LLC. This is where the owners are only liable for debts of the business to the extent of their own investment. So you can protect your business, and you can protect your own assets by putting your business in an LLC, in a limited liability corporation or company. Income and expenses are passed through directly to the owners, which prevents the double taxation when you do an LLC. And there's no limit on how many owners you can have. So that's another big advantage with an LLC. You see a lot of small companies and some big companies that choose to do LLCs for that reason. There's also limited liability partnerships. This is where the partners are liable for their own actions, but they are not entirely liable for the actions of others. So maybe you've got 4 different partners going into a business and one of them just makes some really bad decisions and really hurts the company. That is not going to financially cause the other 3 to be liable. It's going to be reflected on that one partner. So first, we're going to look at common shareholders. So when it comes to a common shareholder, they have a lot of different rights. There's so many benefits in purchasing a share of a company. You own a little bit of that company, and you actually get the right to vote. Now, there might be hundreds of thousands of other owners as well, but you get the right to vote, at least in their annual meeting. They may have other causes to vote as well. You also have a right to a share of a dividend if the corporation chooses to pay dividends. They don't have to. No corporation is required to pay dividends. A lot of corporations do, and they do regularly, and you know that that is a company that's known for it. Walmart is one of them. I've owned some Walmart stock, and they regularly pay out dividends. Now, it might be like 27 cents a share. It's not always going to be a significant amount, but companies paying dividends can be a big benefit to those shareholders. Also, if the company were to liquidate, the common shareholders have some rights to acquire some of the assets during the liquidation process. So we are moving right along here. So we got a lot of definitions in this first video, but there are different share classes within a lot of different companies. They may just have common shareholders, or they may have multiple classes of shares that they're authorized to issue. So that has to have specific rights that are stated to go along with those, and they can be sold at different amounts. So you may see class A, B, and C. You may see preferred versus common stock. A big one that we see is Berkshire Hathaway. They have their A shares and their B shares. Their A shares, they've never split those. So as I'm making the video, and you can check if it's been a while, but right now I think the shares are over 770,000 per share. But if you get the B shares, they're only like $500 a share. I did buy one of those shares recently. So it doesn't mean they're going to be the same price, but they're going to have different rights based on which class of shares that you choose. So if companies have multiple shares or multiple classes, then we're going to break those out, basically starting with the highest class share on the shareholders equity section, as you saw in the beginning of this video with the preferred shares. And that's typically what we see in our academia, in our classes. You're going to see preferred and common stock is typically how those classes are listed out. So if you happen to have a higher class share, you're a preferred shareholder, you have some different rights. Those rights could include one or both of these. When dividends are declared, they don't have to be, but if they are declared, the preferred shareholders will receive a predetermined dividend before the common shareholders get anything. And then they'll see if there's any left over for the common shareholders. So we'll dig deeper into that. Typically, they also have a preference. They have preference over the common shareholders as to the distribution of the assets if the company were to dissolve. So if the company goes out of business, then the preferred shareholders get the assets before the common shareholders. So that's some of the major benefits there. So sometimes they also have the right of conversion. So maybe they can change into multiple common shares. They might have that right. Dividends may be cumulative or non-cumulative. Now, this is really important to understand because you're going to see this a lot, and this is going to be a game changer. So the dividends, if they are cumulative, that means they can be paid in arrears. So that means that if they tell the preferred shareholders that their dividends will be, let's say, $10 a share, but then they don't pay any dividends out for 3 years. Then on that 4th year, they pay out a lot of dividends. If they are cumulative, the preferred shareholders get the dividends for the $10 per share for the past 3 years as well. So they are going to get paid out this year's dividends and all of the prior years, if the amount they've declared covers all of that, before the common shareholders get anything at all. So cumulative is really important. If it's non-cumulative, they still get first dibs, but only on that year. Any prior years that were not paid out, those are just a waste. Those are a loss. So cumulative, really important. Look at that when you're doing your homework problems. Make sure you see if it's cumulative, they're also going to pay any past dividends that they chose not to pay before. Maybe they didn't have profitable years in the past and now they had a really good one. So they'll get those dividends in arrears. They could also be participating or non-participating. If they are participating, that can allow the preferred shareholders to also receive more. On top of that $10 a year that we said, they could also receive even more than that if they are participating. So really important to understand those concepts. Just one more thing I want to cover in this video because we're really just kind of doing a broad overview before we jump into the numbers. But there's a par value set for preferred and common stock. This really is an arbitrary amount that is set for the stock whenever they are authorized in the first place, regardless of what they're sold to the investor for. So we saw that the par value of the common stock for that first example was $1 per share. But they actually sold for much more. So anything they sell for more than the par value, we're going to show that extra that they got, that the company got from their initial public offering, in additional paid in capital. So we're going to see all of these things play out in future videos as I walk through this with the numbers.